U.S. home prices are soaring, recently hitting record highs, and 11 of the last 12 quarters closed higher than the previous ones. Several states witnessed unprecedented year-over-year price increases in 2023, and even skyrocketing inflation rates couldn't prevent housing down payments from reaching all-time highs. As history has shown, real estate markets go through boom and bust cycles, making another crash inevitable. In this video, we'll discuss what's happening in the housing market, the chance of a crash happening soon, how bad a crash could be, and most importantly, what you can do today to position yourself wisely. To understand what's happening, let's check out what's going on with houses right now. The average house price in the US is $431,000, and that's shot up by 31% since 2020. The cost of building materials has skyrocketed since then, making it tougher for builders to make a profit. Because of this, there are way fewer new houses being built, creating a big gap of 3.2 million houses in the US compared to how many people need them. And guess what? This shortage is just making prices go even higher because everyone's trying to snag a home. So why is all this important? Let's dig into the key reasons shaping the housing market. Many analysts are predicting a drop in house prices for 2024, but why? Well, the main reason is affordability, and here's the deal. The best way to figure out if people can afford houses is by looking at the home affordability graph. It's calculated by taking the median home price in a particular area and dividing it by the median household income in that same area. The West Coast is seriously overpriced compared to the East. And guess what? Home affordability is the worst it has been since 1984. CNN reported that currently, 38.6% of the median household income is required to make the monthly payment on the average home purchase. Usually, a home is considered affordable if that number is 30% or less. This is why 99% of Americans cannot afford to buy a house in 2023. Realtor.com even did the math, and you'd need about $110,000 in yearly income just to snag a median-priced house in the US. Tough, right? This all adds up to a serious challenge for anyone dreaming of homeownership in 2024. Now let's discuss why low unemployment rates might burst the housing bubble. This may seem counterintuitive, but stick with me. The current unemployment rate in the US is a super low 3.7%. Now, here's the thing. Since the 1950s, unemployment hasn't stayed this low for long. If you look back, you'll see it's shot up quite a few times, especially during the dot-com crash and the 2008 financial crisis. But listen to this. The average worker saw a wage loss of 6 to 7% for a 1% point increase in the unemployment rate. So, if this trend continues, home affordability might take an even bigger hit. Now, let's talk about another factor: falling interest rates. Jerome Powell and the Federal Reserve are hinting at 3 interest rate cuts in 2024, aiming for a mortgage interest rate range of 5.5 to 6.5%. This move could entice more buyers into the market, creating higher demand and, you guessed it, driving prices up even more. Zillow is even predicting a 3.5% increase in home prices across the country in 2024. So if you're considering buying, these falling interest rates might just add some extra pressure on your wallet. Now, let's shift our focus from short-term trends to the long-term. Throughout history, house prices have followed repetitive seasonal patterns, where price fluctuates throughout the year. We're entering a period where the market tends to slow down. Interestingly, seasonal changes in home prices can contribute up to 20% of the sale price, creating significant fluctuations. This presents a potential opportunity for negotiation if you can spot a good deal. Over the past 50 years, when adjusting for inflation, home values have only seen a decline in 2010. This suggests a consistent pattern, making it quite likely that we'll observe a similar trend over the next 50 years. Now, let's check out 5 actions to take so you can stay safe regardless of market changes. Number 1, opt for a 30-year mortgage to add flexibility to your payments. With this option, you can still pay it off in 15 years by doubling your payments without incurring extra interest if you wish. But in times of economic hardship, you can fall back on minimum payments, providing significant relief. Secondly, always get a fixed interest rate. The entire economy is uncertain, so it makes sense to lock in a fixed monthly payment from the start to get peace of mind. If rates drop, you can seamlessly transition to our third step, refinancing. If you have an opportunity to refinance your mortgage to get a better rate, then do it. If interest rates are lower in the future, you'll be able to reduce your payments and save some extra cash. Our fourth tip is to avoid selling your property. By holding onto it, you'll avoid the impact of short-term market fluctuations and instead benefit from the broader trend of consistently increasing property prices. Next tip is always maintain an emergency fund for unforeseen circumstances. In real estate, unexpected issues like roof repairs, faulty appliances, and water leaks can arise. It's wise to keep enough cash on hand to cover these costs. That's it for today. Check out this video on what price house you can really afford. Thanks for watching.